Gold has surged back into focus this year after hitting a record high in January, selling off sharply in March, and now stabilizing near $4,800 an ounce. But beneath the price swings, the underlying picture is more complex. The World Gold Council says 2025 was a record year for demand, driven by central banks, ETFs, and investment flows. Yet March also saw record ETF outflows, particularly in North America. So are investors misreading what's really driving gold? And what does the data actually tell us about where the market goes next? Well, joining me is Juan Carlos Artigas, America's CEO and Global Head of Research at the World Gold Council. Juan Carlos, thanks very much indeed for your time.
Thank you so much for having me, Devin.
Well, look, let me start here. When you strip out the volatility we've seen this year, what does the underlying data actually say about gold right now? Are fundamentals strengthening or starting to plateau? How do you see it?
I think that gold remains very well anchored in its long-term trend to a degree. And why do I say that? Well, number one, yes, as you mentioned, gold has seen an increase in volatility, but it's up 10% year to date, right? So it is still in positive territory. One of the things that happened is that actually gold prices accelerated very much at the beginning of the year in January, specifically, given a myriad of conditions. And I think that some of that was indeed more momentum driven. Once those flows stabilized and there was some profit taking and some a pullback in the gold price that flushed out the more speculative positions, the gold market has found better footing, right? And you can see that, number one, geopolitical risk remains fairly elevated around the world, and gold as a hedge against that, remains an important point. But also, it is important to understand that gold is a global asset, and that it is not just maybe what U.S. or North American investors, European investors are doing, but also what Asian investors are doing. And there has been consistent demand coming from Asia, even in March.
Yeah. Well, that's interesting. March saw record ETF outflows, particularly in North America, but your own data suggests global demand is still holding up, right? Like you point out to. Are investors overreacting to flows that don't reflect the full picture yet?
Well, I think that what is happening is, number one, these flows specifically pertain to ETFs. ETFs are very cost-effective means to access the gold market, and one of the reasons why people focus so much on them is because you can track them on a daily basis, but they do not represent the whole market. Okay, and that's the first thing, right? So it's one portion of the market that can be very useful to track and monitor, but it's not necessarily going to be reflective of all investors. The second point is that, as you pointed out, March was the first time that we saw outflows, net outflows in a while, and they were highly concentrated in North America, particularly in the US.
Yeah.
And in terms of the larger funds that do have some retail aspect, but also some institutional fast money component to that, it's very common when gold prices move more rapidly to see either inflows or outflows from that point of view. What we have seen even in March is that, in particular, Asia had a positive net inflow into gold-backed ETFs as well. And perhaps more importantly, that month to date in April, we have seen net positive activity across the board.
Yeah. Look, the other side of the spectrum, you have central bank buying. It's been one of the most consistent pillars of demand in recent years. Are we still in that same regime, you think, or are you seeing early signs that this support is starting to moderate?
No, generally speaking, central banks remain net buyers of gold. Of course, when volatility increases, it is very common historically that central banks sometimes pause and come back into the market later. Gold is also utilized as part of reserve asset management. So sometimes you do see sales of gold from central banks. Again, they tend to be temporary sometimes, and there have been some reports of sales in recent months. Some of those are actually swaps, not sales, right? So it is kind of like gold being utilized as collateral very actively as a liquid asset that helps central banks more broadly manage their foreign reserves. But we do think that the trend not only remains in place through the information that is released by central banks, but also through the surveys we conduct. Once a year, we conduct an annual survey, and generally speaking, the comments from central banks themselves is that they do see gold as a strategic asset.
Yeah. Look, I want to talk about the relationship between gold and interest rates. I mean, markets are again debating whether interest rates stay higher for longer. Historically, that's seen as a headwind for gold, yet prices remain elevated. What does your research say about how strong that relationship really is today?
Yeah, look, interest rates as well as the direction of the dollar are an important driver of gold, especially in the short term. And it's part of the opportunity cost of holding gold. Holding everything else constant, higher interest rates or a stronger dollar tend to bring headwinds for gold.
Yep.
Conversely, lower interest rates or a weaker dollar will actually have tailwinds or provide tailwinds for gold. But it's not the only driver. And it is also important to remember. Risk and uncertainty are key also to gold's behavior as a portfolio asset, as a diversifier. And as long as geopolitical and geoeconomic risk remain high, as long as volatility in the market remains high, as long as inflation pressures remain high, all of those things contribute positively to performance. So the point is that those two things combined is not only one of the sides, it's two of the sides. And as we mentioned before, this is not just about investors, individual or institutional, but also central banks that may be making policy decisions rather than just market-driven decisions.
All right, then, from an asset allocation perspective, has gold's role changed in the cycle, you think, Juan Carlos, or are institutions treating it differently compared to previous periods of volatility?
Well, I mean, of course, the fact that gold prices or gold volatility increase raised a lot of questions, right, as to whether it is still playing the role that it can play, or, it can be a diversifier and a risk hedge. From our perspective, and we actually released an analysis, a report today, talking about the fact that, generally speaking, and historical research suggests that when volatility increases in gold, it tends to come down fairly quickly. And perhaps more importantly, gold's correlation to other assets, on average, remains low, especially when you compare it to an increase in correlation between bonds and stocks. Gold can be a useful alternative to investors to manage, overall portfolio risk, right? So it's not just thinking about gold in isolation; it's also understanding the dynamics that are happening across other asset classes.
And then, before I let you go, based on the data you are seeing today, not speculation, right? What gives you the most confidence in gold's outlook, and what is the biggest risk to that view, you think?
Yeah, and actually, to a degree, the fact that the gold market experienced a correction and it has found organic demand coming in and sustaining the price is pointing out to the fact that as a global asset, there's a lot of economic actors, whether it's from the consumer side, from the investment side, or from the central bank side, that are actively participating on the market, right? And, if geopolitical and economic conditions continue in its trajectory or deteriorate, this could provide support. Now, conversely, to your question, if we see a more sustained reduction in geopolitical risk, not a temporary one, but a systemic, profound reduction in geoeconomic risk, that could take away some of gold's risk premium that is currently reflecting. Or if we start to see significant strengthening of the dollar and or interest rates increasing much more than currently expected. Yeah.
Well, just as a quick follow-up, I mean, how much of a downturn do you think that sustained environment, potentially sustained environment, how much of a downturn do you think that can cause to gold? Can it go much further down, you think?
Well, I mean, we don't forecast the price of gold, and we don't produce point forecasts. But what I can tell you is that based on our analysis of last year's behavior, the geopolitical/geoeconomic premium for gold was about 20%. Right. So, that contributed to performance. We don't necessarily think that the whole geopolitical premium would completely dissipate because there are a lot of trends in the world that are still perhaps top of mind for many investors. But as I said, I think that it's important to understand how much of that has positively contributed to gold performance even as of 2025.
Yep. Fair enough, understand that. Juan Carlos Artigas, the Americas CEO and Global Head of Research at the World Gold Council, thanks very much indeed for talking to us.
Thank you so much for having me.